Hello everyone, welcome to JIB CIB English Medium. My name is CART and I hope you all are doing good. So this is your Manthan series where we are preparing for CIB December 25. So if you are visiting to this particular channel, do subscribe to it, and what you can do, you can follow this series for your conceptual clarity and for practice purpose as well. So let's start today's session. Today we are completing and we are going to talk about Unit 10, some important topics which are very crucial for your exam. Yes, so this topic is your capital budgeting for international project investment decision. So let's start. First thing, that is your capital budgeting. So in our previous session also, we have completed about capital budgeting. Yes, that investment decision. In this also, we are going to talk about your capital budgeting, means your investment decision. Capital budgeting is your investment decision. Okay, whether to go with project A, whether to go with project B. Correct? So capital budgeting means what? Method of estimating financial viability of a capital investment over the life of the investment. This is your capital budgeting. Here we are evaluating which financial project or which particular project will be your successful project. This is your capital budgeting. Now, under this particular unit 10 in your module B, we are going to talk about international projects. See, if I talk about Reliance Industry, though they incorporated this business in India, yes, this is our domestic company. Yes, this is our domestic company. But now after globalization, yes, they are working outside India also. Yes, they are setting their business outside India. They are purchasing, selling from outside. Yes, they are thinking to implement new business outside India. So now in this particular unit, we are talking about this side. We are going to talk about this side. When we want to start any new project outside India. Okay. In your previous unit, we have covered this part. This part. In your previous unit. Under unit 9. When we want to start new business in India only. But what if we want to start any new project outside India? So that time we are going to mention it as international projects. International projects. So these projects that are realized across national borders and are often supported jointly by multiple organizations or companies. Reliance can join with Tata. Yes, Reliance can join with this Adani group. Correct? So this is what they're talking in this last point. Multiple organizations can come together or companies can merge together and they can start any new project outside India. Okay, chalo. Now, when we are talking about international projects, okay, the one of the factors which will affect your decision is your foreign exchange. See, if I'm working within India, okay, within India, if I'm working, I am going to use only INR. Yes, I'm going to use only Indian rupees. But as soon as I'm crossing, or I can say if I'm outside India, I cannot use INR. I cannot use this directly. What is the first thing I need to do? I need to convert this INR into any foreign currency. Into any foreign currency. Now that currency can be your dollars, pounds, yen, any type of currency. Okay, so one of the biggest factor, or you can say one of the very important element when you are talking internationally, that is your foreign exchange. Okay, that is your foreign exchange. So this is about one of the factors under international project. Now in this particular unit, we have so many small units, small topics which are actually important and which actually, again and again we have observed in our exams also. Okay, so let's start with the first topic, that is your CAPM, Capital Asset Pricing Model. CAPM model, CAP model. capital asset pricing model. Now, capital asset pricing model, or CAPM, is a financial model that calculates the expected rate of return for an asset or investment. Means what? See, let's take one more example for this. Suppose if I am having rupees 1 lakh. Okay. Now, I want to invest this 1 lakh in Reliance share. Okay, I am purchasing Reliance share. And Reliance is currently providing, suppose, 14%. This is what Reliance is providing if anyone invests in their share. But as an investor, what I want here, I want, suppose, 24%. Yes, so this expectation which we are calculating, randomly we cannot say that I want 50%, 60%, 100%. We cannot say randomly these things. Okay, we need to use one mathematical formula. We need to use one formula to evaluate this amount. And this 24%, which as an investor I am expecting, how I can calculate it with the help of CAPM. That if I purchase by investing 1 lakh, this Reliance share, I want 24% minimum return. Okay? But how I got this 24? That is what we need to learn in this model. Chaliye. So, for calculating this 24%, or you can say this 24% as expected rate of return. Okay, so how to calculate this expected rate of return? For that we need to use this model, that is CAPM model. So for calculating we require 3 factors. For calculating expected rate of return we require 3 factors. First factor is your risk-free rate of return. Next is your beta of a company's share price. Then next, the prevailing expected rate on a portfolio of equity shares in the capital market. These are the 3 factors that I want from this particular company for calculating expected rate of return. Now, risk-free rate of return means, for example, if I purchase any government security, okay, in that security, government is saying we are giving 7% per annum. This is the interest they are saying. Correct? And if it is backed by government, does this security is going to have much risk? No, not at all. Correct? So, this government backed securities, they are not going to have any risk, lower risk or no risk. Because of lower risk or no risk, we are going to receive minimum return, or you can say lower return also. Yes, you can see here only 7%. Correct? So this is a risk-free rate of return. When you are not taking any risk, your return will also very less, very minimum. So this is the risk-free rate of return. What is the risk-free rate of return? That is 7%. No risk, less return, minimum return. Then beta of company's share price. Now beta shows the relationship. Beta shows relationship. Relationship means which relationship? Here relationship between market and your company. And here our company is your Reliance company. Yes. Now how this beta will show the relationship? See, for example, if your market is going up by 1%, okay, and here the relationship beta shows, the beta shows 1. This is the absolute number, that is 1. Okay, market goes up by 1. So here Reliance share will also go by 1% only. Okay, if beta shows 2, means if market goes down by 1, Reliance share will go by 2. Reliance share will also decrease, but by 2. Okay, if here beta says 4, Means if your market goes by 1, Reliance share will go by 4 times. Okay, this is 4 times. So this is the relationship. How much we are fluctuating or we are affecting because of this market. So the individual company and the market, how they both are linked. That is what given by beta. Then the prevailing expected return on a portfolio of equity shares. Okay, what is the expected return on a portfolio? Suppose as an investor, I am not only going to invest in one company, I will invest in different companies. So when I am investing in different companies, I will create portfolio. I have purchased Reliance shares, I have purchased Tata shares, correct? So I have created portfolio. Now after combining all these shares, what is the expected prevailing market return of this? So these are the 3 things which I need to use for calculating CAPM. Chali. So let's solve one. Before solving, let's talk about the formula first. Okay. So what is the formula? Cost of equity. Cost of equity, you can call it as expected rate of return. Cost of equity. Yes. Cost of equity is equal to risk-free rate. Risk-free rate, in our example, we have taken the government security. Okay. Plus levered beta. Take a levered beta which talks about the relationship. Multiply by market risk premium. Market risk premium means if I invest in Reliance company, if I am investing in Reliance company and Reliance is giving me only 14%. But actually Reliance is giving me 14% because I am taking risk. That company is giving me actual 14%. The answer is no. Why no? Because without taking any risk, just now we have talked now, without taking any risk, government security is providing me 7%. Without taking any risk, I am receiving 7%. And Reliance is saying all 14% is because of us. 7% so we are getting to without risk. So how come you are saying you are giving actual 14%, purely 14% because of you? No. So here, for taking risk, what is the actual return we are receiving? What is the return we are receiving because of taking risk? That is the reason the term is risk premium. Risk premium. What is the return we are receiving because of the risk? That is market risk premium. Okay. So cost of equity, RF plus levered beta into RM minus RF. This is the formula. So let's solve one question based on this. A stock has a beta of 1.5, expected return of the market portfolio 12%, risk-free rate 4%. What is the expected return or cost of equity? RF plus levered beta, RM minus RF. Only 3 factors we require. Okay, so RF is your this 4%. Beta 1.5. Expected rate of return, that is 12%. Risk free 4%. Everyone calculate and tell me the answer. Bracket difference is 8. 8 into 1.5 plus 4 means 16% is our answer. This is our cost of equity, or you can say expected rate of return. Okay, this is your answer. Now, let's solve one more question based on this. So, if the risk-free rate is 6%, the expected return on the market is 14%. Beta of stock is 1.5, expected return of the stock using CAPM. So, now let's solve this. Risk-free given, that is 6%. Beta is also given, that is 1.5. Then expected return is given, that is 14%. Only we require these 3 things. So let's solve the cost of equity. RF plus beta, RM minus RF. So RF is 6% plus 1.5, 14% minus 6%. 14 minus 6 into 1.5 plus 6. Correct answer is your 18%. Okay, this is your answer. Okay, chali. So this is about your CAPM. Okay, this is your CAPM, one very important method under your international projects. Now, related to this, we have one more theory, that is your arbitrage pricing theory. This is also known as your APT theory. This is also known as APT theory. Now, under CAPM, we used to calculate with the help of only market. Okay, that to share market only. Only share market. But as per APT theory, they are saying when you are calculating the return, your risk, your return, that particular factor is not just market. You have other factors as well. Like you have GDP, domestic inflation, stock indices, gold prices, risk-free rate of return. Means as per APT, they are saying we are having more factors which will affect as an individual's return. So when you are considering more factors, okay, for calculation as an expected rate of return, that is your arbitrage pricing theory. That is your arbitrage pricing theory. So the formula is expected return equal to RF plus beta of first factor multiply with the risk premium plus beta of your second factor multiply with risk premium of the second factor. Then just multiply with the respective beta with the respective premium. And then you add each and every factor's outcome and you will receive the cost of equity. So arbitrage pricing model says for calculation of any expected return, you cannot say everything is because of your market. You have your other factors as well. You need to consider those factors. That is what APT talks about. Okay, let's solve one question. So the following four factors have been identified as explaining a stock's return, its sensitivity to each factor, and the risk premium associated with each factor have been calculated. Here RP means risk premium. Okay, so this is your first factor, that is gross domestic product, first factor, and beta and the risk premium. Inflation is your second factor, beta and risk premium. Third factor is your gold prices, third factor and risk premium. Fourth factor, Sensex index return, fourth beta, fourth risk premium. And this is your risk-free rate. Okay, so let's calculate the expected return. Formula is RF plus beta 1 multiplied by risk premium 1 plus beta 2 multiplied by risk premium 2 plus beta 3 into risk premium 3 plus beta 4 into risk premium 4. Correct? Chali. So let's put this figure 3% plus 0.6 into 4% plus 0.8 into 2% plus, see, for the third factor you have minus 0.7 into 5% plus 1.3 into 9%. Now this is your pure maths equation. Yes, so now this equation is your homework. Everyone please solve this because I have given each and everything related to this formula. Now it's your turn to solve it and share your answer. Through comment. Okay, let's see whether you are calculating correctly or not, because that is the ultimate game. Hana, you know the formula, you know the topic, you know the concepts, but while calculation, while doing mathematical thing, we are making mistake. So let's solve and let's see how many of you are getting the correct answer. Okay, chali. So this is your APT. Next question. What is the primary objective of capital budgeting? Estimating the cash balance of a company. Well, evaluating the financial viability of a capital investment, short-term investment, a company's annual budget. No. Correct answer is your answer B. Then, risk-free rate of return is 5%. Expected return on the expected market is 12%. Beta is 1.5. You need to calculate the expected return of the stock using the CAPM formula. Okay, again, this is your homework question. Today, I'm giving you 2 questions as your homework. And if you want to know the answer, you can join this Telegram group. Okay, I will post the correct answer on this Telegram group. So do join this Telegram group by using this QR code. And remember one thing, here is one more question. Okay, so I'm just giving you the brief and try to solve it by yourself. Ultimately, the more you are going to practice, the more you are going to understand the concept. Okay, you understood the concept. Okay, now it's time for practice. So practice as much as you can. So for expected return or for a cost of equity, RF plus beta, RM minus RF. Yes, so today I'm giving you not 2 questions, not 1 questions. Today I'm giving you 3 questions as your homework. So everyone try to attempt it, and for the answer, join Telegram group. Yes. But remember one thing, this unit, if you see from your ABFM book, they are very lengthy. Yes, and we have so many sub-points on which we need to do the calculations, numerical questions, numerical topics we have. So for that, you can join our upcoming batch, that is Officers Pro batch. Now in this batch, we are actually designed this batch for upcoming CAIIB December 25, in which we are covering your online live classes, mock tests, ebooks. Yes, for all 4 compulsory subjects. So remember, for clearing in a first attempt for 2 increments, you require conceptual study. If you think just before 1 week, if you are giving and you can clear it, the chances are very less. Okay, unless and until your concepts are clear, you have practiced it, you are having some probability. Yes, so to make it confirm, to make it in your more positive side, you can join this batch, that is Officers Pro batch. And remember, for enrolling this, you can use the coupon code, that is Y895. With this, you can receive maximum discount, and along with this, if you're purchasing Mahapack, okay, in case of Mahapack, if you're purchasing, you can use the same coupon code. While with this, you will get double validity as well. That is the benefit. Okay, so now let's wind up this session. Thank you for joining. Take care and bye-bye.